Before we begin, please remember that the information provided in this video is for educational and informational purposes only. I am not a financial advisor, and this presentation should not be considered financial or legal advice. The mortgage and real estate markets are complex and vary by state and individual circumstances. You should always consult with a qualified and licensed professional, such as a financial advisor, mortgage professional, and real estate attorney, before making any major financial decisions. Your financial situation is unique, and the information presented here may not be suitable for your specific needs. The single biggest financial mistake you can make when buying a home isn't overpaying for the house. It's choosing the wrong person to get your mortgage from. This one decision, this one fork in the road, could silently drain an extra $67,000 from your bank account over the life of your loan. Think about that. $67,000. That's a brand new luxury car. It's a college fund for your kid. It's the difference between retiring comfortably and working an extra 5 years you didn't have to. And the most frustrating part? Most people make this mistake without even realizing they're making a choice at all. Let me paint a picture for you. Imagine two families, the Smiths and the Joneses. They live in the same town, they have similar jobs, similar credit scores, and they're both looking to buy a home for $500,000. They even find identical houses right across the street from each other. The Smiths do what most people do. They walk into the big, familiar national bank on the corner, the one where they have their checking account, and they sit down with a friendly person called a loan officer. They get approved, they're happy, they sign the papers, and they move in. Now the Joneses across the street do something different. They call someone called a mortgage broker. They never even step foot in a bank. A few weeks later, they move into their identical house. For the next 30 years, both families make their mortgage payments on time, every month. But here's the kicker. When both families make that final payment 30 years from now, the Joneses will have paid tens of thousands of dollars less for the exact same house. So what did the Joneses know that the Smiths didn't? They understood the fundamental, game-changing difference between a mortgage broker and a loan officer. And by the end of this video, you will too. We are going to pull back the curtain on the entire mortgage industry. This isn't just a vocabulary lesson. We are going to dissect these two roles so you understand on a gut level who they really work for, the hidden ways they get paid, the secret advantages of each, and the critical disadvantages that can cost you a fortune. Most importantly, I'm going to give you a clear framework to decide which one is the absolute right choice for your specific financial situation, because the right answer for your neighbor might be the wrong answer for you. Making the right choice here is like getting a massive, unadvertised discount on the biggest purchase of your life. Making the wrong one is like willingly lighting a pile of your own money on fire, year after year. So let's start with the one you're probably most familiar with, the one the Smiths went to see, the loan officer. A loan officer, sometimes called a mortgage loan originator or a bank loan officer, is a direct employee of a specific lending institution. That institution could be a massive national bank like Chase or Bank of America, it could be a regional bank, or it could be your local credit union. The key word here is employee. They work for one company. Think of it this way. A loan officer is like a salesperson at a Ford dealership. They are an expert on every single Ford on the lot. They can tell you all about the F-150, the Mustang, the Explorer. They can get you a great deal on any Ford. But if the best car for your family's needs is actually a Toyota, they can't help you. They can't even tell you about the Toyota. It's not their job. Their job, their loyalty, and their paycheck are all tied directly to selling you a Ford. A loan officer works in the exact same way. They are an employee of, let's say, Big Bank USA. They can only offer you the mortgage products that Big Bank USA has on its menu. That's it. They have a specific set of loan types, maybe a 30-year fixed, a 15-year fixed, an FHA loan, a VA loan, and they have the specific interest rates and underwriting guidelines that Big Bank USA has decided upon that day. The loan officer is the facilitator. They take your application, they gather your documents, and they present your file to their bank's underwriting department. They are your guide, but only within the walls of that one institution. Now, this can have some serious advantages. Let's call this the pro column for the loan officer. First, there's the power of an existing relationship. If you've banked with the same institution for 20 years, there's a level of comfort and trust. You can walk into a familiar branch and talk to a real person. The process can feel simpler because it's all in-house. Your checking account, your savings, and now your mortgage are all under one roof. Sometimes banks offer what's called relationship pricing. They might knock a tiny fraction of a percentage point off your interest rate or waive a fee because you're a loyal customer bundling services. The second, and arguably bigger, advantage is access to something called portfolio loans. These are unique, in-house loans that the bank doesn't sell off to the secondary market like Fannie Mae or Freddie Mac. The bank keeps these loans on its own books. Why does this matter to you? Because they can make their own rules for these loans. Let's say you're a self-employed business owner with a complex income structure that doesn't fit the standard mold. A traditional loan might be impossible to get. But your bank, who sees your business accounts and knows your history, might have a special portfolio loan designed for exactly someone like you. A mortgage broker would never even know this loan exists. It's an exclusive off-menu item available only to that bank's customers, through their loan officer. So the loan officer offers simplicity, potential relationship perks, and exclusive access to certain unique loan products. It sounds pretty good, right? But now we have to look at the other side of the coin, the con column, and this is where the Smiths got into trouble. The single biggest disadvantage is the one we already mentioned: severely limited options. By going to one bank, you are only seeing one tiny slice of the entire mortgage market. You have absolutely no idea if the rate they're offering you is competitive. Is it the best rate you could possibly qualify for? You don't know. You only know it's the best rate that one bank is willing to offer you today. Their rate could be 0.25% or even 0.5%, higher than what another lender across town would offer. On a $500,000 loan, a small difference like that is what adds up to that $67,000 in extra interest payments over 30 years. Second, you have to ask the critical question: who does the loan officer really work for? They work for the bank. Their primary responsibility, their fiduciary duty, is to their employer. Their job is to originate profitable loans for the bank using the bank's products. Of course, they want you to be a happy customer, but when push comes to shove, their loyalty is to the institution signing their paycheck, not necessarily to finding you the absolute best deal available anywhere in the marketplace. And here's a huge one. A no from a loan officer is a dead end. If you submit your application and the bank's underwriter denies your loan for any reason, maybe your debt-to-income ratio is a hair too high for their specific rules, or they don't like the property appraisal, that's it. The process stops. The loan officer can't just pick up your file and take it to another lender. You're back to square one. You have to start the entire process all over again with a completely different bank, submitting a new application, pulling your credit again, and wasting precious time. In a competitive housing market where you have a financing contingency deadline, a denial like this can cause your entire home purchase to fall apart. To truly comparison shop, you, the borrower, have to do all the legwork yourself. You have to go to Bank A, fill out their application, then go to Bank B, fill out their application, then go to Credit Union C and do it all again. Each of these applications can result in a hard inquiry on your credit report, which can temporarily lower your score. It's an exhausting, time-consuming, and potentially damaging process. So the loan officer is the company specialist. They offer a streamlined process and potential in-house specials, but it comes at the steep cost of limited choice and a potential conflict of interest. This sounds like a massive disadvantage, right? But there are specific situations where walking into your local bank and sitting down with their loan officer is absolutely the smartest, most strategic move you can make. Before we reveal what those situations are, we need to understand their counterpart, the independent operator, the free agent of the mortgage world, the mortgage broker. And this is where the entire game changes. So, what exactly is a mortgage broker? Forget the stiff, corporate definition. Think of a mortgage broker as your personal financial matchmaker. They aren't tied to a single institution. They don't wear the jersey of one specific bank. They are independent agents who have relationships with a vast network of different lenders. Dozens, sometimes hundreds of them. This network includes big national banks, smaller regional banks, credit unions, and specialized private lenders you've probably never even heard of. Imagine this: you walk into a giant shoe store. A loan officer works for Nike. They know everything about Nike shoes. They can tell you about the Air Max, the Jordans, the Pegasus. They are experts in Nike. And if a Nike shoe fits you perfectly, that's fantastic. But what if your foot is a little too wide? What if you need a specific type of arch support that Nike doesn't offer? The Nike employee can't sell you a pair of New Balance or Adidas. Their only option is to try and squeeze you into another Nike, or tell you they can't help. The mortgage broker, on the other hand, owns the entire shoe store. They don't work for Nike or Adidas or New Balance. They work for you. You walk in and say, "I have a wide foot, I overpronate, and I need a shoe for trail running." The broker doesn't just point you to one aisle. They survey the entire landscape. They know that a certain model from ASICS is perfect for overpronation, and that a niche European brand has the best grip for rocky terrain. They bring you options you didn't even know existed, all designed to find the perfect fit for your unique needs. This is the broker's fundamental superpower: access. A loan officer has access to one playbook, their banks. A broker has access to an entire library of playbooks. This difference becomes critically important the moment you submit your application. When you go to a direct lender and apply with their loan officer, you are applying to one single underwriter at one single institution. Your entire financial life, your credit score, your debt-to-income ratio, your employment history is judged by that one set of guidelines. If their computer says no, that's it. The road ends there. You have to pick yourself up, go to a different bank, and start the entire invasive, time-consuming process all over again, getting another hard pull on your credit each time. With a mortgage broker, the experience is completely different. You fill out one application. You provide your documents one time. Your credit is pulled one time. The broker then takes your complete file and becomes your champion. They don't just submit it to one lender. They strategically shop your loan to their entire network of lenders to find the best possible home for it. If lender A is too conservative about your student loan debt, the broker knows that lender B is more lenient. If lender C has a problem with your self-employment income, the broker knows that lender D has a special program specifically for entrepreneurs. It's like having a master key that can open dozens of doors, instead of a single key that only fits one lock. You're not just hoping one bank says yes. You're leveraging competition among multiple banks to get the best possible outcome. But here's the secret sauce, the part most people never learn about. How can a broker, this middleman, often get you a better interest rate than if you walk directly into the bank yourself? It seems counterintuitive, right? The answer lies in a hidden channel of the lending industry known as wholesale lending. Think of it like this. Every major lender has two front doors. There's the retail door where the general public walks in. This is where their loan officers work. The prices here are the standard everyday consumer prices. But then there's another door around back. It's the wholesale door. This entrance is only for mortgage brokers. Lenders give brokers access to lower, wholesale interest rates because the broker is doing a massive amount of work that the bank would otherwise have to do themselves. The broker finds the client, takes the application, collects all the documents, structures the file, and essentially hands the lender a perfectly packaged, ready-to-go loan on a silver platter. They are bringing the lender business in bulk, without the lender having to spend money on marketing, advertising, or the salary of a massive retail sales force. In return for this efficiency, the lender offers the broker preferential pricing. The broker can then pass that savings on to you. It's the exact same reason a case of soda at Costco is cheaper per can than buying a single can from a vending machine. You're accessing a different, more efficient supply chain. Now the obvious question is, if they're doing all this work, how does the broker get paid? This is crucial for you to understand. In most cases, the broker is paid by the lender, not by you directly. This is called lender-paid compensation. When a lender provides a wholesale rate sheet to a broker, it includes different rate options. A slightly higher interest rate might come with a larger commission, or rebate, paid to the broker. A lower interest rate might come with a smaller commission. And right now you might be thinking, wait a minute, doesn't that mean the broker is incentivized to stick me with a higher interest rate to make more money? That's the million-dollar question, and thankfully federal regulations put in place after the 2008 financial crisis have a very clear answer. No. Laws like the Dodd-Frank Act strictly prohibit brokers from being compensated based on the terms of the loan. In other words, they can't earn a bigger commission just for putting you in a higher rate loan. Their compensation is a fixed percentage that they establish with the lender beforehand, regardless of which rate you choose. Their primary financial incentive is simply to get your loan closed. If the loan doesn't close, they don't get paid a dime. This aligns their interests directly with yours. Their goal is to successfully navigate the maze and get you to the finish line. Let's make this real. Meet Sarah, a freelance graphic designer. For the last 3 years, she's been incredibly successful. But her income isn't a neat and tidy W-2 paycheck. It comes from multiple clients, it fluctuates month to month, and she has significant business write-offs. Sarah has a 20% down payment and a great credit score. She walks into a major household name bank. The loan officer is friendly, but when they plug her information into their automated underwriting system, the computer sees her variable income and spits out a denial. The loan officer apologizes, but their hands are tied. The bank's rigid guidelines don't have a box for someone like Sarah. For that bank, she's simply unfundable. Dejected, Sarah's realtor recommends a mortgage broker. The broker listens to her story, looks at the same tax returns that the big bank rejected, and smiles. He says, "The big banks hate this kind of stuff. But I work with 3 different lenders who specialize in bank statement loans for self-employed borrowers. They don't even look at your tax returns. They just want to see consistent deposits into your business account for the last 12 or 24 months." The broker submits her file to those 3 niche lenders. 2 of them come back with approvals. A week later, Sarah is in escrow on her dream home. That is the power of a broker. They aren't just order takers. They are problem solvers, strategists, and navigators. They specialize in the complex, the unusual, and the scenarios that don't fit neatly into a box. While the loan officer is an expert on one set of rules, the broker is an expert on the entire game. They know which lenders have the most forgiving debt-to-income ratios, which ones are best for jumbo loans, and which ones can close a VA loan in under 21 days. This doesn't mean brokers are flawless. A disorganized or inexperienced broker can be a bottleneck. And since they are a middleman, communication can sometimes be less direct than with a loan officer who sits down the hall from the underwriter. But for anyone with a situation that is even slightly outside the norm, that access to options can be the single most important factor in their home buying journey. So we have the bank's loyal soldier, the loan officer, armed with the deep knowledge and resources of a single powerful institution. And we have the independent mercenary, the mortgage broker, with a versatile arsenal of lenders and a talent for navigating complex financial terrain. But which one do you want fighting for you in the trenches? The answer depends entirely on who you are. Are you a W-2 employee with a perfect 800 credit score? Or are you a business owner with a complicated financial history? The wrong choice could cost you not just the deal, but tens of thousands of dollars over the life of your loan. And next, we're going to break down the exact borrower profiles that are a perfect match for each of these professionals. So let's play matchmaker. On one side, we have you, your unique financial DNA, your dreams, your anxieties about this massive purchase. On the other, we have the mortgage broker and the loan officer. The question isn't who is better. The question is, who is better for you? Let's start with the most common profile out there. The first-time homebuyer. Let's call them Sarah and Tom. They've done everything right. They worked hard, saved up a down payment, and have decent credit scores in the low 700s. But they are terrified. They've heard horror stories from friends about closings falling apart in hidden fees. They don't know the difference between an FHA loan and a conventional loan. They don't know what PMI is or why it matters. They feel like they're about to walk into a final exam for a class they never took. For Sarah and Tom, a great mortgage broker isn't just a good choice. It's practically a necessity. Why? Because their primary need isn't just a loan. It's an education and a guide. A loan officer at a big bank might be perfectly competent, but they're handling dozens of files. They might pre-approve Sarah and Tom for their bank standard 5% down conventional loan and send them on their way. The rate seems okay, but is it the best rate? Is it the best program? The loan officer works for the bank, and their toolbox only contains the tools that one bank offers. A mortgage broker, on the other hand, works for Sarah and Tom. A good broker will sit them down for an hour and become their personal finance professor for home buying. They'll explain that because their credit isn't quite stellar, an FHA loan might actually offer a better interest rate, despite the mortgage insurance. They'll also know about a specific wholesale lender that has a special grant program for first-time buyers in their state, something the big national bank would never offer. The broker becomes their navigator. They have a map of the entire lending landscape, while the loan officer has a map of just one city. For the overwhelmed, the anxious, and the uninitiated, the broker provides choice, education, and a crucial buffer between them and the intimidating world of underwriting. They translate the jargon and fight the fires, so the first-time buyer can focus on picking out paint colors. Now let's flip the script completely. Meet our second profile, the seasoned pro. Let's call him David. David is not buying his first home. He's refinancing his third rental property. He can calculate amortization schedules in his sleep. His credit score is north of 800. He isn't looking for a guide. He's looking for a transaction. His primary and perhaps only goal is to secure the absolute lowest interest rate and the lowest possible fees, and he wants it done yesterday. For David, marching straight to a direct lender, a big bank or a credit union where he already has a relationship, is often the most strategic move. He doesn't need the smorgasbord of options a broker provides because he already knows exactly what he wants. A 30-year fixed, no points, minimal closing costs. By going directly to the source, he cuts out the middleman. Now, a broker's commission is often paid by the lender, but that cost is still baked into the rate somewhere. By going direct, David might be able to negotiate a slightly better deal, especially if he's a valued customer. Imagine David has his business checking and investment accounts at Big Bank USA. He can call up a loan officer he's worked with before and say, "Here's my file. I need to close in 25 days. I see you're advertising 6.5%. My credit is 810 and I have $500,000 in assets with you. What can you do for me?" That loan officer can often go to their manager and get a relationship discount, shaving an eighth or even 0.25% off the rate. Furthermore, since the loan officer, the processor, and the underwriter are all employees of the same company, a clean, simple file like David's can fly through the system with incredible speed and efficiency. For the experienced, the financially straightforward, and the rate-obsessed, the direct loan officer offers a streamlined path to the finish line with potential pricing benefits a broker may not be able to match. But what about the people who don't fit into a neat little box? This brings us to our third, and perhaps most critical profile, the maverick. This is Maria, a brilliant freelance graphic designer. Her business is booming, but her financials are creative. She doesn't get a W-2 every 2 weeks. She gets paid by 30 different clients. Her income is fantastic, but it fluctuates. And on her tax returns, her accountant is a wizard, writing off everything from her home office to her software subscriptions. The result is that her official taxable income looks much lower than the actual cash flowing into her bank account. If Maria walks into a big, traditional bank, she's likely to hit a brick wall, and hit it hard. The loan officer will plug her numbers into an automated underwriting system, a computer algorithm. The algorithm will see her low taxable income, her multiple sources of income, and her high business expenses, and it will spit out a single soul-crushing word, denied. The loan officer might be sympathetic, but their hands are tied. The computer said no. This is where a mortgage broker becomes a superhero. A broker's greatest asset is their network of lenders. Not just the big banks, but smaller, more specialized wholesale lenders that the average person has never even heard of. When the broker looks at Maria's file, they don't see a problem. They see a puzzle. They know that lender A is notoriously difficult for self-employed borrowers. But they also know that lender B, C, and D specialize in what are called non-QM, or bank statement loans. These lenders don't even look at tax returns. Instead, they'll analyze the last 12 or 24 months of her business bank statements to verify her cash flow. They understand the reality of being an entrepreneur. The broker knows how to package Maria's story, how to present her file to the right underwriter at the right company who is empowered to use common sense instead of just relying on an algorithm. For the self-employed, the gig worker, the person with a recent credit hiccup, or anyone whose financial life doesn't fit the 9-to-5 mold, a broker isn't just an option. They are often the only option to get a deal done. Finally, there's a fourth profile we can't ignore: the community loyalist. This is James, a public school teacher who has been a member of the local credit union since he was 16. He values trust and personal relationships over squeezing every last hundredth of a percentage point out of a rate. He wants to work with an institution that's invested in his community because he's invested in it too. For James, the choice is simple. He walks into his credit union and talks to their loan officer. Credit unions are fundamentally different from banks. They are not-for-profit cooperatives owned by their members. This philosophical difference often translates into tangible benefits. They frequently offer highly competitive rates and lower fees because they're not trying to maximize profits for shareholders. More importantly, many credit unions hold their loans in their own portfolio instead of selling them off to Fannie Mae or Freddie Mac. This gives them immense flexibility. If James has a slightly unusual situation, maybe a student loan and a specific type of forbearance that a big bank's algorithm would flag, the credit union's loan officer can literally walk down the hall and talk to the underwriter, explaining the context. It's a human-centered process. For the borrower who prioritizes trust, community, and a personal touch, the loan officer at a local credit union can provide a sense of security and a fair deal that feels worlds away from a faceless national lender. So the first-timer needs a guide. The pro needs efficiency. The maverick needs a problem solver. And the loyalist needs a trusted partner. It's not about one being universally superior. It's about aligning the professional's core strengths with your specific needs. But knowing your profile is only half the battle, because both brokers and loan officers have ways of getting paid that can be completely invisible to you. And what you don't see can absolutely hurt you. Next, we're pulling back the curtain on the secret world of fees, commissions, and the mysterious yield spread premium that could be costing you thousands without you ever knowing it. Let's talk about the price tag. When you buy a car, there's the sticker price, the MSRP. Then there are the dealer fees, the destination charges, the undercoating they try to sell you. The final price is never the sticker price. A mortgage is 1,000 times more complicated, and the price tag isn't just one number. It's a tangled web of rates, points, and fees. And at the center of that web sits the person guiding you, your mortgage broker or loan officer. How they get paid directly influences the price you pay, not just today but for the next 360 months. First, let's look at the bank loan officer. It's the simpler model of the two. A loan officer is an employee of a specific bank, a credit union, or a direct lender. Think of them as a specialist at the Apple Store. They know everything there is to know about iPhones and MacBooks, but they are not going to tell you about a new Samsung phone that might be a better fit for you. Their universe is limited to their employer's products. Their compensation reflects this. They typically earn a base salary plus a commission. That commission is a small percentage of the loan amount, often called basis points. 1 basis point is 1/100th of a percentage point. So, if a loan officer's commission is 50 basis points on a $400,000 loan, they'd make $2,000. Simple enough. The key takeaway here is that their incentive is to close the loan using one of their bank's products. They get paid by their employer for selling their employer's financial product. The conflict of interest is relatively straightforward. They might be motivated to push a loan product that's more profitable for the bank, or one that helps them hit a sales quota, even if it's not the absolute best option on the entire market for you. But because their product shelf is limited, the variables are also limited. Now let's step into the world of the mortgage broker. This is where the curtain gets really heavy, and what's behind it can be shocking. A broker, remember, is the independent intermediary. They don't work for a lender, they work for you theoretically. They have access to dozens of lenders and hundreds of loan products. Their whole value proposition is finding you the best deal from this vast marketplace. So how do they get paid for this service? There are two main paths, and the one you go down has massive implications. The first and most common is called lender-paid compensation, or LPC. On the surface, this sounds fantastic. The lender, the wholesale bank that is actually providing the money, pays the broker's commission. So to you, the borrower, the broker's service appears to be free. Who doesn't love free? But there is no such thing as a free lunch in finance. Ever. If you are not paying for the product, you are the product. This is where we uncover the skeleton in the industry's closet. The yield spread premium, or YSP. Even though regulations have changed its name and how it's disclosed, the concept is alive and well. It is the single most important and most misunderstood factor in how brokers are paid. Imagine you walk into a broker's office and, based on your credit score, income, and down payment, you qualify for a mortgage at a 6.5% interest rate. The wholesale lender tells the broker, for this borrower, the base rate, what we call the par rate, is 6.5%. If you close the loan at this rate, we'll pay you a 1% commission. But the lender also gives the broker a menu of other options. They say, hey, Mr. Broker, if you can convince the borrower to take a 6.75% rate instead, just a quarter point higher, we'll pay you a 2% commission. We'll give you a bonus for selling a more expensive loan, because that higher rate is more profitable for us over the long term. That bonus, that extra 1% the lender pays the broker for locking you into a higher rate, is the yield spread premium. It's a kickback. It's a financial incentive for the person who is supposed to be on your side to sell you a more expensive product without you ever realizing it. You were eligible for 6.5%, but you walk out with 6.75%, feeling happy that you got a loan. Meanwhile, that extra quarter point could cost you tens of thousands of dollars in additional interest over the life of the loan. You are paying the broker's free commission, but you're doing it slowly, painfully, through a higher monthly payment for the next 30 years. It's baked right into the rate. This creates a monumental conflict of interest. Is the broker showing you the best possible loan for you? Or are they showing you the loan that pays them the biggest commission? Now, the Dodd-Frank Act of 2010 put some guardrails on this. It banned brokers from being paid by both the borrower and the lender on the same transaction and required more transparency. But the fundamental structure of lender-paid compensation still exists. The incentive for a broker to steer you towards a lender that pays them more, even if that lender doesn't have the absolute rock-bottom rate for you, is still very real. So what's the alternative? It's the second path. Borrower-paid compensation, or BPC. This is far more transparent. Here, you and the broker agree on their fee up front. It might be a flat fee, say $5,000, or it might be a percentage of the loan amount, typically around 1% to 2%. You pay this fee directly as part of your closing costs. The lender is not involved in the broker's commission at all. The immediate reaction for most people is, why would I pay a fee myself when I can have the lender pay it? It's a fair question. But with borrower-paid compensation, the broker's incentive is now totally aligned with yours. Their job is simple. Find the absolute lowest interest rate and best terms possible from their network of lenders, regardless of what commission the lenders are offering. Because their fee is fixed and paid by you, they have zero financial reason to push you into a higher rate loan. They are now truly working for you. Paying that fee up front could save you a fortune in interest by securing you a lower rate that you would have never been shown under a lender-paid model. This is the critical decision point. With a bank loan officer, you know who they work for, the bank. The lines are clear. With a mortgage broker, you have to ask the hard questions to figure out who they're really working for. Are they working for you, or are they working for the lender who offers the highest yield spread premium? So, how do you protect yourself? You have to become the investigator. You must ask, point blank, how are you compensated on this loan? Is it lender paid or borrower paid? If it's lender paid, you need to dig deeper. Ask them, can you show me your compensation agreement with the lender? Or, can you show me the raw rate sheet from the lender so I can see the different rate and commission options available? A transparent broker will have no problem showing you this. A broker who hesitates, who gives you a fuzzy answer, is waving a giant red flag. Understanding how the money flows is the first step to taking control of the process. But the rate and the commission are only two parts of the puzzle. There's another layer of financial engineering that can either save you a fortune or cost you one. And it all revolves around the magic and mystery of points. You've probably heard of them, discount points to lower your rate, or lender credits that seem like free money. But these points are a double-edged sword. A tool that can be used by a savvy professional to your benefit, or a weapon used against you to hide fees and inflate costs. Let's pull back the curtain on this financial sleight of hand. Imagine you get two loan offers for the exact same $400,000 house. One is from a big bank's loan officer, and the other is from an independent mortgage broker. The bank offers you a stunningly low 6.25% interest rate. The broker, on the other hand, offers you a 6.75% rate. At first glance, the choice is obvious, right? The bank is the clear winner. But then you look at the fees. The bank's offer has $10,000 in closing costs. The broker's offer? Almost zero. Now you're confused. Is the broker hiding something? Is the bank ripping you off? The answer is possibly neither, or possibly both. You might be looking at the exact same loan, just dressed in different clothes. To understand this, you need to see what they see. You need to look at the secret menu. Every single morning, lenders send out a document to loan officers and brokers called a rate sheet. This is the holy grail. It's the menu of options for the day. And it's not just one interest rate. It's a whole spectrum of rates, each with a price tag. In the middle of this spectrum is something called the par rate. Think of par as the baseline, the 0 point. If you take the par rate, say it's 6.5% today, it costs you nothing extra, and it gives you nothing back. It's the standard off-the-rack price. But this is where the game is played. The rate sheet shows that you can get rates below par. You can get that sexy 6.25% rate the bank was offering. But it's not free. Next to that 6.25% rate on the sheet is a cost listed as a number. Let's say it's negative 2.5. This number represents the points you have to pay. Point is simply 1% of the loan amount. So on your $400,000 loan, 1 point is $4,000. If that 6.25% rate costs 2.5 points, you would have to pay $10,000 extra at closing just to get it. That's the $10,000 in fees on the bank's offer. This is called buying down the rate, or paying discount points. You are literally prepaying interest upfront in a lump sum in exchange for a lower monthly payment over the life of the loan. Now, is this a bad deal? Not necessarily. It's a math problem. Let's do it quickly. The difference between the 6.5% par rate and the 6.25% rate you bought is 0.25%. On a $400,000 loan, That 0.25% saves you about $60 a month. You paid $10,000 up front to save $60 a month. So, to figure out if it was worth it, you find your break-even point. You divide the $10,000 you paid by the $60 you save each month. The answer is 167 months, or just under 14 years. If you are absolutely certain you will live in that house and not refinance for more than 14 years, then congratulations, paying those points was a brilliant financial move. Every month after that 14-year mark, you're saving pure cash. But what if you're like most Americans who move or refinance every 5 to 7 years? If you sell that house in year 6, you've spent $10,000 to save only about $4,300. You lost money. You fell for the allure of a low rate without understanding the total cost. Now let's look at the other side of the rate sheet, the other side of that double-edged sword. The rate sheet also shows rates above the par rate. You can choose a 6.75% rate or a 7% rate. And next to these rates are positive numbers. These are credits. For taking a rate that's higher than the baseline, the lender will actually pay you. This payment is called a lender credit, or sometimes yield spread premium. It's a rebate. So when the mortgage broker offered you the 6.75% rate with zero closing costs, what did they do? They looked at their rate sheet and saw that the 6.75% rate came with a credit of, let's say, 2.5 points. 2.5% of your $400,000 loan. That's a $10,000 credit from the lender. The broker then used that $10,000 credit to pay for all of your closing costs, the appraisal, the title insurance, the processing fees, everything. You bring less cash to closing, but you have a slightly higher monthly payment. Again, not necessarily a bad deal. If you're tight on cash and need to get into the house with minimal out-of-pocket expense, this is a fantastic option. You're essentially financing your closing costs into the loan through a higher interest rate. Here is the critical distinction, the moment where the sword is either used for you or against you. The bank loan officer, working for a single institution, typically has a much more limited set of options. Their bank might incentivize them to sell you on buying down the rate because the bank makes more money up front. They might present that 6.25% rate with $10,000 in costs as their best deal, without ever clearly explaining that you could take a 6.5% rate and save yourself that $10,000 in cash. They're selling you a specific product. Worse, this is how hidden fees get buried. An unscrupulous lender can pad your closing costs with what we call junk fees, inflated administrative fees, processing fees, underwriting fees. Then they give you a slightly above par rate to generate a lender credit. They use that credit to pay for all the closing costs, including their padded junk fees, and present you with a no closing cost loan. You feel like you got a great deal because you didn't have to bring cash to the table, but you didn't realize that you're paying for those inflated fees plus interest on them for the next 30 years. They use the complexity of the system against you. A good mortgage broker, on the other hand, operates differently. Their entire value proposition is choice. They can access the rate sheets from dozens of different wholesale lenders. A good broker will sit down with you and lay out the entire spectrum of options. They'll say, look, the par rate today is 6.5%. Your payment would be X. If you want to pay about $10,000 at closing, I can get your rate down to 6.25%, and your payment will be Y. If you're short on cash and want me to cover all your closing costs, we can take a 6.75% rate, and your payment will be Z. Given that you told me you might be transferred for work in 4 years, paying the $10,000 in points makes absolutely no sense. I recommend we either take the par rate or we take a small credit to cover some of your costs. What feels best for you? You see the difference? It's the shift from a salesperson pushing a product to a strategist presenting a customized plan. The loan officer at the bank is playing checkers with the bank's one set of pieces. The broker is playing chess, able to see the moves available from 50 different lenders and position you for the win. This flexibility, this ability to manipulate the rate and cost structure to fit your specific financial goals, not the bank's, is the broker's superpower. But this entire system, this dance of points and credits, hinges on how the person arranging your loan gets paid for their work. And understanding who really pays the broker, and how that compensation is legally mandated to be transparent, is the final piece of the puzzle that will change how you see mortgages forever. So let's pull back the curtain on the single most misunderstood aspect of the mortgage world: broker compensation. For decades, this was a black box, a place where hidden fees and back-alley deals thrived. But a financial cataclysm in 2008 and the sweeping regulations that followed changed everything. Understanding this change is not just interesting. It's your primary defense against getting a bad deal. At the highest level, a mortgage broker can be paid in one of two ways: The first, and by far the most common, is called lender-paid compensation or LPC. The second is borrower-paid compensation or BPC. Let's start with the one you're most likely to encounter: lender-paid. In a lender-paid scenario, the wholesale lender, the big institution that actually provides the money, pays the broker a commission for bringing them your loan. Now your first thought might be, wait a minute, if the lender is paying my broker, doesn't that mean my broker works for the lender, not for me? And that is the million-dollar question. The answer, thanks to modern regulations, is a resounding no. But to understand why, we have to take a quick trip back in time to the Wild West days of mortgages before 2010. Before the great financial crisis, the system was fundamentally broken. A broker could engage in what was called dual compensation. They could charge you, the borrower, an upfront origination fee, say 1% of the loan amount. Then they could turn around and get a secret kickback from the lender for selling you a higher interest rate than you actually qualified for. This kickback had a name: the yield spread premium, or YSP. It was a bonus paid by the lender to the broker for locking you into an above-market rate. The higher the rate they convinced you to take, the bigger their secret paycheck. Think about that incentive structure. It was a direct, calculated conflict of interest. The broker had a financial motivation to put you in a worse loan. It was profitable to be unethical. This practice was a significant contributor to the subprime mortgage crisis, where people were steered into risky, high-cost loans they couldn't afford, all because it padded the pockets of the person they were supposed to trust. Then the entire system collapsed, and out of the ashes rose the Dodd-Frank Act, a massive piece of legislation designed to prevent this from ever happening again. Tucked inside it was the Loan Originator Compensation Rule, or LO Comp Rule. This rule wasn't just a slap on the wrist. It was a complete demolition and rebuilding of how mortgage originators get paid. It did two revolutionary things. First, it completely outlawed dual compensation. Period. A broker can now be paid by the lender, or they can be paid by the borrower. They can never ever be paid by both on the same transaction. The secret backchannel of money was sealed shut. Second, and this is the most critical part, it made it illegal for a broker's compensation to be based on the terms of the loan. A broker cannot be paid more for putting you in a higher interest rate. They can't get a bonus for selling you an adjustable rate mortgage instead of a fixed rate one. They can't make extra for a loan with a prepayment penalty. Their commission is a fixed percentage of the loan amount, and that percentage cannot change based on the type or terms of the loan they get for you. Let me say that again because it is the most important sentence in this entire video. A mortgage broker today makes the exact same amount of money whether they get you the best possible rate on the market or a terrible one. Their entire incentive structure has been flipped on its head. Since they can't make more money by giving you a bad deal, their only path to success, the only way they get paid at all, is to win your business in the first place. And how do they do that? By using their access to dozens of lenders to find you the best possible rate and terms that you can qualify for. Their financial interest is now legally, structurally aligned with your financial interest. So, how does this lender-paid compensation actually work in practice? Before a broker ever brings a client to a wholesale lender, they establish a compensation agreement. For example, the broker might tell lender A, "On any loan I bring you, my compensation will be 2% of the loan amount." They might tell lender B, "My compensation with you is 1.75%. This agreement is set in stone and filed with the lender. It cannot be changed on a whim for your specific loan. When your broker submits your application to that lender system, the lender's rate sheet automatically accounts for that pre-agreed 2% commission. So, if the lender's internal wholesale or par rate is 6.25%, the rate sheet they present back to the broker for you, the borrower, might show options like 6.75% with 0 points, or 6.5% if you pay 1 point in closing costs. That difference, that margin between the wholesale rate and the retail rate you see, is where the broker's commission lives. This is why it's called lender paid. At the closing table, the lender literally wires the commission to the broker. But it's crucial to understand that the cost of that commission is financed by you, the borrower, through the interest rate over the life of the loan. It's not free money. It's a method of financing the cost of the service. Now, what about the other model? Borrower-paid compensation. This is much more straightforward. You and the broker agree on a fee up front, either a flat dollar amount or a percentage of the loan. Let's say you agree to pay them a 1.5% fee on a $500,000 loan, which is $7,500. You pay that fee directly at closing as part of your closing costs. In exchange, the broker goes to their network of lenders and requests the pure, raw wholesale interest rate with no commission or margin built in. You get the lender's absolute rock bottom rate, but you have to bring a check for $7,500 to the closing table to pay for the broker's service. So which one is better? Over 95% of transactions use the lender-paid model. Why? Cash. Most homebuyers are scraping together every penny they have for a down payment and closing costs. They simply don't have an extra $10,000, $15,000, or $20,000 in liquid cash to pay a broker fee on top of everything else. Financing the broker's fee into the rate makes homeownership accessible. It might mean a slightly higher monthly payment, but it also means you don't have to drain your life savings just to get the keys. Borrower paid can be a powerful strategy for a select few. If you're taking out a very large jumbo loan, say $3 million, a 1.5% lender-paid commission would be a staggering $45,000. In that case, negotiating a much smaller flat fee with a broker, say $15,000, and paying it out of pocket to get the lowest possible wholesale rate could save you a fortune. It's for people who are cash-heavy and playing a long-term game on interest savings. Now, here's the kicker that ties it all back to the bank loan officer. How do they get paid? A loan officer at a big bank is also a commission salesperson. The bank they work for sets the retail interest rates for the day. And baked into that rate is not just the cost of the money, but the bank's entire operational overhead. The loan officer's commission, the processor's salary, the underwriter's salary, the marketing budget, the rent on their fancy downtown office, and a healthy profit margin for the bank shareholders. When you get a loan estimate from a bank, you'll see an origination fee. But you will not see a line item that says loan officer commission. It's all bundled together, hidden inside the bank's overall cost structure. The cost is absolutely there, you are paying it, it's just opaque. With a broker, the law demands the opposite. Because of the LO comp rule, their compensation must be disclosed with radical transparency. On page 2 of your official loan estimate, under Section A, Origination Charges, there will be a crystal clear line item. It will state the broker's exact commission percentage and the total dollar amount, and it will often explicitly say, paid by lender. This is the broker's great paradox and, frankly, their superpower. They are legally forced to show you exactly what they're making on your loan. It might feel jarring to see a line item for $10,000 to ABC Mortgage Brokerage, but what you're seeing is not a junk fee. It's the transparent cost of having an independent expert shop, dozens of lenders, and manage the entire complex process for you. The bank loan officer is getting paid a commission too, you just don't get to see it. The cost is simply absorbed into the rate and fees they offer you. One is transparent by law, the other is opaque by design. So the old fear of the shady broker in a back room getting rich by tricking you is a ghost of the past. The system has been rebuilt to ensure that their primary goal is your primary goal. Finding the most competitive loan available in their vast network to win your trust and your business. But let's be honest, the real question burning in your mind probably isn't about their goals or motivations. It's about your money. It all comes down to one thing. Who is going to get me the better deal? Who is actually cheaper? Is the broker just a glorified middleman adding an unnecessary fee? Or is the loan officer at the big bank hiding costs in the fine print? This is the million-dollar question, or more accurately, the several $100,000 question, and the answer is far more fascinating than you think. To find it, we have to follow the money. We need to pull back the curtain and see exactly how each of these professionals gets paid, because how they make their living directly impacts how much you spend on yours. Let's start with the loan officer. It's the simpler model of the two. A loan officer is an employee of a bank, a credit union, or a direct lender. Think of them like a salesperson at a high-end electronics store. They are experts on every product their company sells, but they only sell products from that one company. They typically earn a base salary, just like any other employee, but the bulk of their income comes from commission. This commission is a percentage of the loan amount you take out, and it's paid to them by their employer, the bank. This is a critical point. Their paycheck comes from the institution whose products they are selling. So when you get a rate quote from a loan officer, that rate has the bank's entire business model baked right into it. It has to cover the loan officer's salary and commission. It has to cover the bank's marketing budget, all those TV commercials and online ads. It has to cover the cost of their fancy downtown office buildings, their massive support staff, the underwriters, the processors, the executives. And of course, it has to generate a healthy profit for the bank and its shareholders. The loan officer's job is to sell you that all-inclusive package. They generally have very little, if any, power to change the rates or the fees. They are presenting you with the official prepackaged retail price set by the institution. There's nothing inherently wrong with this. It's a clean, straightforward model. You're buying a brand name product directly from the source. The price is the price. Now let's wade into the world of the mortgage broker. This is where most of the confusion and most of the opportunity lies. The old myth is that a broker is just an extra layer, a middleman who has to add their own fee on top of the lender's costs, which must make it more expensive. It sounds logical, right? But it's based on a fundamental misunderstanding of how the mortgage market actually works. It ignores the massive hidden world of wholesale lending. Think about it like this. When you buy a can of soda from a vending machine, you're paying a retail price. That price covers the cost of the soda, the cost of the machine, the salary of the person who stocks it, and the profit for the vending company. But the vending company didn't pay that price. They bought thousands of cans directly from the manufacturer at a much lower wholesale price. Mortgage brokers are like that vending machine company. They don't deal with the retail side of lending. They have access to the wholesale market. They work with dozens of different wholesale lenders, large financial institutions that don't have public-facing branches or massive advertising budgets. These lenders don't want to deal with individual borrowers. Their business model is to operate leanly, creating the loan products and letting brokers do the frontline work of finding and vetting customers. Because these wholesale lenders have dramatically lower overhead, no fancy branches, no Super Bowl ads, they can offer their loan products at significantly lower wholesale rates. This is the secret sauce. So, how does the broker get paid for connecting you to this hidden market? There are two primary ways. The most common is called lender-paid compensation, or LPC. In this model, the wholesale lender you choose pays the broker a commission for bringing them a fully packaged, ready-to-go loan application. The lender is essentially paying the broker for doing the work their own loan officers would have done. This compensation is built into the interest rate they offer, but because they started from a much lower wholesale rate, the final rate you get, even with the broker's compensation included, is often still more competitive than the retail rate you'd get from a big bank. The lender is happy because they acquired a new loan without the retail cost, the broker is happy because they got paid for their expertise and service, and you are happy because you got a great rate. The second, less common method is borrower-paid compensation, or BPC. Here, you and the broker agree on a fee up front, either a flat dollar amount or a percentage of the loan. You pay the broker directly. In return, the broker can then go to their network of wholesale lenders and request the absolute rock bottom, par interest rate, a rate with zero commission or markup built into it. This can sometimes result in an even lower long-term interest rate, but it means you have to pay the broker's fee, either out of pocket at closing or by rolling it into your total loan amount. It's a trade-off. Pay more now to potentially save more later. A good broker will walk you through the math on both options to see which one makes the most sense for your financial situation. The crucial takeaway here is that the idea of a broker simply adding a fee is a dangerous oversimplification. They are providing access to a different marketplace entirely, the wholesale market, where the baseline costs are lower. The final price you pay is often the lower wholesale rate plus the broker's compensation. The magic, the entire reason the broker model exists, is that this combination frequently beats the all-in-one retail price offered by a direct lender. Now, I know what some of you might be thinking. This sounds great, but couldn't a broker just stick me with a lender who pays them a higher commission, even if the rate is worse for me? This is the ghost in the machine. This is the fear that holds people back. And it's a valid fear based on how the industry used to work over a decade ago. There was a practice called yield spread premium, which was a fancy term for a kickback. A lender would pay a broker a bonus for locking a borrower into a higher than necessary interest rate. It was a terrible system that created a direct conflict of interest. But, and this is arguably the most important regulatory change in the mortgage industry in the last 50 years, that practice is now illegal. Following the 2008 financial crisis, the Dodd-Frank Act and the establishment of the Consumer Financial Protection Bureau completely overhauled mortgage compensation rules. Today, a broker's compensation is fixed. They cannot legally be paid more by a lender for putting you in a higher rate loan. Their commission percentage is set in advance and it applies across the board, regardless of which lender or which loan product you choose from their network. This was a game changer. It legally and financially aligned the broker's interest with your interest. Their only path to success, their only way to earn your business and get paid, is to use their access to the entire wholesale market to find you the absolute best deal they possibly can. They win only when you win. So let's circle back to the ultimate question. Who is cheaper? the loan officer or the mortgage broker? The honest, no-fluff answer is, it depends, but a broker gives you a vastly better chance of finding the cheapest option. A loan officer can only tell you what one company is offering on one particular day. A mortgage broker can tell you what 20, 30, or even 50 companies are offering on that same day. They create a bidding war for your business. Will there be times when a massive national bank is running an aggressive promotion, and their retail rate happens to be the best on the market? Absolutely. Will there be times a local credit union has a special portfolio product that a broker can't access? Yes, that can happen too. But the sheer mathematical probability is on the broker's side. They are fishing in a much larger ocean, filled with leaner, more competitive wholesale lenders. The value of a broker isn't the guarantee that they are always the cheapest, but that they are your single point of access to the entire market to discover who is the cheapest. They do the shopping for you. A loan officer doesn't shop. They just tell you the price in their one store. Cost, however, is only one part of this complex equation. A low rate is fantastic, but it's worthless if you can't get the loan approved in the first place. What happens when your file isn't a simple cookie-cutter application? What happens when you're self-employed with complicated tax returns, or you have a unique credit situation, or you need a loan closed on a brutally tight deadline? This is where the true difference between a broker and a loan officer transforms from a simple price comparison into a chasm of capability and expertise. And that is where we are going next. Let's dive straight into that chasm. Imagine you found the perfect home. It's not a cookie-cutter house in a subdivision. It's a beautiful log cabin on 10 acres. Or maybe it's a barn-dominium, a converted barn with stunning modern interiors. Or perhaps it's a multi-unit property you plan to live in while renting out the other units. You are ecstatic. This isn't just a house. It's your dream. You take your pre-approval from Big Bank USA and go to your loan officer, the friendly guy who helped you get started. You show him the property listing. He smiles, types the address into his system, and his face drops. Oh, he says, we might have a problem. The bank's automated underwriting system has flagged the property. It's non-traditional. It doesn't fit into the neat little box that their guidelines require. Log cabins have different construction standards. A barn-dominium is a zoning nightmare for their system. A multi-unit property over a certain number of units requires a commercial loan, not a residential one, according to their specific, internal rules. This loan officer, as nice and as competent as he may be, works for one bank. He has one set of rules, one playbook. His bank has decided for its own risk management that it doesn't want to lend on properties like yours. These internal rules are called overlays. They are extra layers of restrictions the bank puts on top of the basic government-backed loan requirements. So even if your loan would technically be approved by Fannie Mae or Freddie Mac, the bank itself says no. The loan officer can't just call up an underwriter and plead your case. He can't submit your loan to a different bank. His hands are tied. He is an employee of an institution, and the institution has spoken. For you, the dream is dead. You're crushed. Now let's rewind. You take that same unique property to a mortgage broker. You explain the situation. The broker doesn't frown. They lean in. Their eyes light up. They see a puzzle to be solved. They say, okay, this is what we call a non-conforming property. Most big banks won't touch it, but I work with 50 different lenders. Let me make some calls. The broker knows that out of those 50 lenders, there are 3 or 4 that specialize in unique properties. One might be a portfolio lender, a bank that holds its own loans instead of selling them, so they make their own rules. They love log cabins. Another might be a regional credit union that understands rural properties and barn-dominiums because they're common in the area. The broker knows exactly how to package your loan application for these specific lenders. They highlight the property's unique strengths, provide extra documentation on its value and construction, and they speak directly to an underwriter who they have a personal relationship with. They are your advocate, your champion, navigating a complex market on your behalf. A week later, you get the call. You're approved. The dream is alive. That is the chasm. For a standard, simple transaction, the difference is minimal. For anything outside the box, it's everything. Let's take another scenario. It's not the property that's unusual. It's you. Let's say you're a successful freelance web developer. You've been in business for 5 years, your income is fantastic, and you're making more money than ever. But like any smart business owner, you have a great accountant. You write off your home office, your new computer, your business travel, your software subscriptions. As a result, The adjusted gross income on your tax returns looks much lower than the actual cash flowing into your business bank account every month. You go to the loan officer at a direct lender. They ask for 2 years of tax returns. They plug the numbers from line 31 of your Schedule C into their calculator. The computer spits out a debt-to-income ratio that's way too high. The loan officer says, "I'm sorry, based on the income you've claimed to the IRS, you just don't qualify for this much of a loan." You try to explain. You show them your bank statements, invoices, the river of cash that flows through your business. They nod sympathetically, but again their hands are tied. The bank's rules are rigid. They look at tax returns. Period. It's a black and white system, and your vibrant, colorful financial life doesn't fit. Now, you take that same situation to a mortgage broker. The broker doesn't just see a tax return. They see a self-employed success story. They say, "Standard underwriting isn't going to work for you. Tax returns are killing your qualification. So we're not going to use them." You're confused. How is that possible? The broker explains the world of non-QM, or non-qualified mortgages. These are loans for people who don't fit the standard government-regulated box. The broker knows lenders who offer bank statement loans. Instead of looking at your tax returns, these lenders will analyze 12 or 24 months of your business bank statements to determine your actual cash flow and use that for qualification. The interest rate might be a little higher, sure, but it's the difference between getting a loan and not getting one at all. The broker knows exactly which documents you need, how to present your business income in the most favorable light, and which lender has the best bank statement program for a web developer. They are a specialist. The loan officer is a general practitioner. When you have a complex case, you don't go to the family doctor, you go to the specialist. Finally, let's talk about speed. The market is hot. You find a house you love, but there are 5 other offers. To make your offer stand out, you need to promise the seller a fast closing. Not the standard 45 days. You need to close in 21 days. It's a huge strategic advantage. You call your loan officer at the big bank and ask, "Can you close a loan in 21 days?" You can almost hear them shudder through the phone. They'll say, "Well, I can certainly put a rush on it, but I can't make any promises." Here's why. At that big bank, your loan file is a cog in a massive machine. It goes from the loan officer's desk into a queue for a processor. Once the processor gets it, it goes into another queue for the underwriter. Then it goes into another queue for the appraisal department. Every department is a silo. Every queue is long. The loan officer has almost no control over the timeline. They can send a few emails begging for a rush, but they're just one employee among thousands. Your 21-day deadline is at the mercy of a slow-moving bureaucracy. Good luck. Now, you call the mortgage broker with the same request. "Can you close in 21 days?" The broker says, "It'll be tight, but let's do it. Here's the plan." The broker isn't just a salesperson. They are a project manager. They have a dashboard view of the entire lending market. They know right now, today, which lenders are operating fastest. They'll say, "Okay, lender A is a great lender, but their turn times for underwriting are at 10 days right now. We can't use them." Lender B, however, just streamlined their process and they're turning files in 48 hours. We're going with them. The broker has direct relationships. They can call the account executive at the wholesale lender and say, "Hey, I'm sending you a clean file for a rush closing. Can you give it a look?" They can order the appraisal immediately from a management company they personally trust to be fast and reliable. The broker quarterbacks the entire process. They are on the phone daily with the processor, the underwriter, the appraiser, the title company, pushing every single piece forward. They are not a cog in a machine. They are the operator of the entire system, and the system is custom built around getting your specific loan to the finish line on your timeline. In each of these scenarios, the weird house, the weird income, the weird timeline, the loan officer is limited by their employer. They offer one menu from one kitchen. The broker is a personal shopper who can go to any grocery store in the city to get the ingredients needed for your unique recipe. Their value isn't just in finding a slightly lower rate on a simple loan. It's in their ability to solve complex problems and make the impossible possible. Let's put this into a real-world context. Imagine a young couple, we'll call them Mark and Jessica. Mark is a W-2 employee at a tech company, but Jessica is a freelance photographer. She's incredibly successful, but her income is variable. On paper, with tax write-offs for her equipment, her net income looks much lower than her actual cash flow. They've saved up a solid down payment, their credit is great, and they've been loyal customers at a big national bank for over a decade. Naturally, they go to that bank first. They meet with a loan officer, a perfectly nice person who takes all their documents. A week later, they get the call. Denied. The loan officer apologetically explains that based on the bank's formula for averaging Jessica's last 2 years of tax returns, their debt-to-income ratio is just too high. The loan officer says, "I'm sorry, our underwriting guidelines are very strict on this. There's nothing more I can do." Mark and Jessica are devastated. They feel like they failed. They think the dream is over. But their real estate agent tells them not to give up and refers them to a local mortgage broker. They're skeptical, but they make the call. The broker listens to their entire story, looks at the same documents, and smiles. She says, "I see the problem. The issue isn't you, it's the bank. They have a specific, rigid rule for self-employed borrowers. But they're not the only game in town." The broker explains that she has access to dozens of different lenders. She knows of 3, in particular, that specialize in working with entrepreneurs. One of them allows for a bank statement loan, where they qualify the borrower based on the cash deposits into their business account, not their tax returns. Another lender has a more flexible way of averaging income if you can show a strong history of growth. She submits their file to the lender who specializes in bank statement loans. 10 days later, Mark and Jessica are pre-approved for the home of their dreams. What just happened there? How could one lender say absolutely not, and another say welcome aboard, with the exact same financial profile? The answer lies in one of the single most important, yet least understood, concepts in the mortgage world: overlays. Think of it like this. For most common loans like conventional FHA or VA loans, there is a baseline set of rules established by the governing bodies Fannie Mae, Freddie Mac, or the federal government. These are the absolute minimum requirements to get that type of loan. For example, Fannie Mae might say a borrower needs a minimum credit score of 620 and can have a maximum debt-to-income ratio of 50%. That's the foundational rulebook. But then the individual lender, the bank or credit union, gets that rulebook. And they have the right to add their own stricter rules on top of it. These extra, more restrictive rules are called overlays. Why would they do this? Risk. A giant national bank is managing a portfolio worth billions, or even trillions of dollars. They are incredibly risk-averse. They don't want to just meet the minimum standard. They want to be extra safe. So they add overlays. They might take that Fannie Mae rulebook and say, "Okay, Fannie Mae says 620 is the minimum credit score, but our bank will not lend to anyone with a score below 660. That's our overlay." Or they might say, "Fannie Mae allows a 50% debt-to-income ratio, but we're capping all of our borrowers at 45%. That's our overlay." They might add overlays for anything and everything. Stricter rules for calculating self-employment income, lower limits on how much of a down payment can be a gift from family, refusing to lend on certain types of properties like non-warrantable condos, or requiring more cash reserves left over after closing. This is where the fundamental difference between the loan officer and the broker becomes crystal clear. The loan officer at the big bank works inside a single box. That box is defined by their bank's specific set of overlays. They cannot step outside of that box. If you don't fit their bank's unique, stricter rules, they have nowhere else to take you. They can't walk your loan file across the street to their competitor who has different rules. Their hands are tied. They have one product, one set of guidelines, one answer. For Mark and Jessica, that answer was no, because the bank's self-employment overlay was a brick wall. The mortgage broker, however, doesn't work inside one box. They have a key to every box in town. They work with dozens of different lenders, from giant wholesale lenders to small, niche banks, and they know the intricate details of each one's rulebook. They know which lenders have which overlays. Their job is to be a matchmaker. They look at your unique financial situation, your recipe, and they know exactly which lender, which grocery store, has the specific ingredients you need. So when the broker met Mark and Jessica, she immediately identified the problem. It wasn't their income. It was the bank's overlay. She knew that lender A has a strict overlay on self-employment, but lender B has no overlay on that at all, and will just follow the base Fannie Mae guideline. And she knew that lender C doesn't even use tax returns and offers a special program for entrepreneurs. Instead of hitting a brick wall, she presented them with multiple pathways to a yes. This is not a rare occurrence. This happens every single day. Maybe you have a slightly lower credit score. The FHA minimum is $580 for a 3.5% down payment. But you'd be hard-pressed to find a major bank that will lend to a 580 score. Most have an overlay requiring 620, 640, or even higher. A broker, however, will have multiple lenders in their network who are perfectly happy to lend all the way down to the true 580 FHA minimum. Maybe you have student loans in deferment. Some banks have an overlay that requires them to count 1% of your total student loan balance as a monthly payment, even if your actual required payment is zero. This can absolutely kill your debt-to-income ratio. A broker knows which lenders don't have this overlay and will use your actual or income-based repayment plan amount, potentially saving your qualification. Maybe you're buying a multifamily property to live in one unit and rent out the others. Some banks have overlays that make these properties much harder to finance. A broker knows the lenders who love these kinds of investments and have dedicated programs for them. This ability to navigate overlays is a broker's superpower. A denial from a single bank often isn't a denial of your worthiness as a borrower. It's simply a reflection that you don't fit into that one institution's specific, conservative, risk-averse box. The loan officer in that bank can only tell you that you don't fit in their box. The broker can take you and find the box that was practically custom-built for you. So while a bank loan officer is an expert on one set of products and one set of rules, a mortgage broker is an expert on the entire market. They understand the nuances and niches of dozens of lenders. This gives them an enormous advantage in solving problems and finding solutions for borrowers who aren't a perfect, cookie-cutter applicant with a 20% down payment, an 800 credit score, and a W-2 job they've held for 20 years. For everyone else, the self-employed, the person with a past credit hiccup, the investor, the first-time buyer stretching to make it work, this difference can be the deciding factor between getting the keys to your new home or walking away in disappointment. So the broker has the advantage of options, of navigating the complex web of lender rules to find a home for almost any loan. But what about the actual process? Once the loan is submitted, who is really on your side when things get tough? The person who works for the bank or the person who works for you? The answer to that question reveals the final, and perhaps most important, difference between them. This is the moment of truth in any home loan journey. It's the part that happens behind the curtain, in a department called underwriting. An underwriter is the person at the bank who has the ultimate authority to approve or deny your loan. They are the judge, jury, and often the executioner of your homeownership dream. Their job is not to be your friend. Their job is to protect the bank's money by scrutinizing every single page of your file, every bank statement, every pay stub, every line of your tax returns, looking for risk. And trust me, they are very, very good at finding it. This is where the paths of the loan officer and the mortgage broker diverge so dramatically. Let's imagine a scenario. You're 2 weeks away from closing. The moving truck is booked. You've already started packing boxes. Then you get a call. The underwriter has a problem. Maybe they found a large undocumented cash deposit in your checking account from 3 months ago. It was a gift from your grandma for your birthday, but you forgot to get a gift letter. Or maybe your credit score dropped 7 points because you opened a new credit card to buy a washer and dryer for the new house, something you were explicitly told not to do, but you did it anyway. Or maybe the underwriter is questioning the stability of your overtime income, even though you've earned it consistently for 3 years. This is a loan condition. Your loan is now stuck, suspended in limbo until this condition is cleared. Panic sets in. If you're working with a loan officer at a direct lender like a big national bank, here's what happens next. Your loan officer goes to the underwriter to plead your case. They explain the situation, but the underwriter works for the same bank. They are bound by a rigid, often inflexible set of internal rules called overlays. These are extra rules the bank adds on top of the basic federal guidelines to reduce their risk even further. The underwriter might say, "I understand, but our bank policy states we cannot accept this type of gift deposit without a letter dated at the time of the deposit. We can't use the overtime. The credit score is now too low for this program." What can your loan officer do? Not much. Their hands are tied. They work within a closed system. They can't just walk your file down the hall to a different underwriter with a different opinion. They can try to escalate it to a manager, but that manager also works for the same bank and is bound by the same policies. They have one playbook, one set of rules, and one final decision maker. If that decision is no, your loan is dead. It's over. They'll apologize, say they did everything they could, and you're back to square one, with your moving truck idling at the curb and your dream home slipping through your fingers. Now let's rewind and run the exact same scenario, but this time you're working with a mortgage broker. The broker gets the same call from the underwriter at lender A. The underwriter has the same problem with the gift deposit, the overtime, or the credit score. The broker's first move is the same. They advocate on your behalf. They know how to structure the explanation, provide supporting documents, and frame the situation in the best possible light, because they've dealt with hundreds of underwriters at dozens of different banks. They know what works. But let's say this particular underwriter at lender A is having a bad day. They won't budge. The answer is a hard no. Is your loan dead? Absolutely not. For the broker, this is not a dead end. It's a detour. The broker says, "Okay, thank you for your time." They hang up the phone, and they immediately pull your entire loan file from lender A. They turn to their computer, where they have access to the wholesale platforms of 50 other lenders. They know that lender B doesn't have that specific overlay about gift deposits. They know that lender C has a program that allows for a slightly lower credit score. They know that lender D's underwriters have a better understanding of commission and overtime income. Within an hour, your loan application is repackaged and resubmitted to lender B, a lender who is a much better fit for your specific scenario. You, the borrower, might not even be aware of the drama that just unfolded. All you get is a call from your broker saying, "Hey, just wanted to give you an update. Everything is moving along smoothly. We're still on track to close on time." The broker is your firewall. They absorb the problems and navigate the complexities of the system for you. A loan officer is trapped inside one system. A broker has the entire system at their disposal. They aren't just trying to fit your square peg financial life into one bank's round hole. They are searching the entire market to find the hole that was perfectly shaped for your peg from the very beginning. This is the ultimate safety net. It's the difference between having one shot to make it work and having dozens of chances. When an unexpected issue arises, and in mortgages, the unexpected is practically guaranteed, the loan officer's job is to see if the problem can be solved within their bank's rigid framework. The broker's job is simply to solve the problem, period. Whatever it takes. This fundamental difference comes down to a simple question of alignment. Who does the person you hired truly work for? A loan officer is an employee of the bank. Their primary allegiance and their paycheck comes from that institution. Their career advancement depends on following that bank's rules and successfully selling that bank's products. They are serving their employer's interests, which they hope align with yours. A mortgage broker, on the other hand, is an independent professional whose business lives or dies based on one thing: successfully closing your loan. They don't get paid a salary from any bank. They get paid a success fee, and only when you get the keys to your house. Their legal and financial incentive is 100% aligned with your best interest. They don't work for the lender. The lender works for them, competing for their business. And by extension, competing for your business. So, when you're making the single largest and most emotionally charged financial decision of your life, the question you have to ask yourself is this: do you want to walk into a single brand name store and talk to a salesperson who can only sell you the suits they have on their rack, in their sizes, at their prices? Or do you want to hire a personal shopper? Someone who knows your measurements, your budget, and your style, and who can go to every single store in the entire mall to find the one perfect suit that was made just for you, and who can then get all those stores to compete on price to give you the best possible deal. A loan officer is a salesperson for one bank. A mortgage broker is your personal shopper for the entire mortgage market. That is the key difference.